Hi everyone, it's Paul Brown here from Wealth21. This video we're going to discuss tolerance to investment risk. Okay, so just a reminder that anything in this video is general information only. It doesn't cover your particular circumstances. If you have questions relating to your particular situation, please seek advice from us or a qualified financial advisor. This chart here is actually one of the questions that we discuss with new clients and existing clients when we're reviewing their risk profile questionnaire. So basically, this is the range of returns over 1 year for 6 different investment strategies. For example, the third strategy along, if the investment market conditions were very favourable, that strategy might earn 21%. But if they're very unfavourable, it might result in a loss of 16%. Okay. So now we'll look at the various different risk profiles. At Centrepoint, we actually use 6 different risk profiles, from defensive through to high growth plus. But I'm going to focus just on the 3 risk profiles where the majority of our clients would be, and that's conservative, balanced, and growth. And in terms of the mix of defensive and growth assets, defensive assets would be cash and fixed interest investments, and growth assets typically shares and property, domestic and overseas. So for a conservative strategy, you would have 70% in defensive assets and 30% in growth assets. For a balanced strategy, you would have 50-50. Okay, and for growth, you would have 30% in defensive assets and 70% in growth assets. So the next row, the range of returns, is similar to the previous slide with the range of returns over a 1 year period. And the next 2 rows give the range of returns over 5 years and over 10 years. And you will see that over the longer the time period, the narrower the range of returns, and that's because over time the returns average out. And these ranges are forecast based on a 95% confidence interval. So it's not a prediction, it's just based on statistical data. Okay, so for example, a range of returns for a conservative portfolio over 10 years would be between 0.9% and 6.1%, and for a growth portfolio between 0.2% and 11.1%. So let's look at past returns from 2002 to 2021, the calendar years, so 20 calendar years there. This does take into account the period of GFC, so we'll cover that in a moment, but let's just look at the average returns. So these are based on index returns with an allowance for fees. So the average return for conservative was 4.1% per annum, balanced 4.8%, and growth 5.3%. And the accumulated value of $100,000 over 20 years would be conservative $225,000, balanced $254,000, and growth $281,000. So you get what we expect, which is the higher level of risk or allocation to growth assets, the higher the level of return. Now looking at the actual highest and lowest returns over that period of time. So for conservative, the highest return was in 2004 at 10.3%. And for balanced, it was 13.8%, and growth, it was 19.6% in 2013. And the lowest returns were all in the year when we had the GFC, or the GFC was most impact, and that was 2008. And conservative negative 7.4%, balanced negative 14.6%, and growth negative 23.6%. Just want to quickly show you the chart. So this is a 20-year chart of the Australian Stock Exchange, and it shows that the GFC was a very significant fall, 54%. Over a year and a half effectively. So it did have an impact on obviously returns in 2008, but even the average return over 20 years. Okay, so, and the final row there just gives the number of calendar years where there was negative returns, and conservative had 3 in the last 20, and balanced and growth 4 in the last 20. Okay, so what do we learn from that data? Well, obviously the higher allocation to growth assets will very likely provide a higher return over 20 years. But also that the higher allocation to growth assets increases the potential for more significant losses over short time periods, say 1 or 2 years. That data actually shows the range of returns over the past calendar year was fairly close to those ranges that we talk about in our risk profile questionnaire. And also any risk profile or any strategy, long-term investment strategy, has the potential to record a loss over a short time period, like a single calendar year. So when you have an investment strategy in place, it's important to be patient with it and focus on the long-term aims of that strategy. And finally, there is a trade-off between risk and return. So your investment strategy needs to pass your sleep test, okay? And if the allocation to growth assets is more than you're comfortable with, then that's generally a reason to change to a more conservative approach. Okay, any questions? Please give us a call or send us an email. Thank you.